This Tuesday morning in London, the Canadian dollar is sitting right where it wants to be, near a 2-month high against the US dollar. US dollar to Canadian dollar is trading around 1.3930, virtually unchanged from yesterday, but that stability tells a bigger story. For context, the pair touched a low not seen since mid-June last Friday after a surprising drop in the wider dollar index to just 99.5. That move slammed the greenback across the board, yet the Loonie has refused to give back its gains. Today, the dollar index is clinging to a modest rebound at 99.8, but that bounce is fragile. The real reason the Canadian dollar is holding firm is not just US weakness, it is a story of oil, jobs, and a market holding its breath for the inflation report that could rewrite the entire rate cut timeline. Three forces have converged in the past few days. First, crude oil prices have risen again, and because Canada is a major oil exporter, every uptick acts like a tailwind for the Loonie. Reports from this morning specifically cite stronger oil as a key support for the Canadian dollar. Second, Canada's own employment data surprised to the upside, reminding traders that the domestic economy is not rolling over just yet. That contrasts sharply with the US, where a hot non-farm payrolls report earlier in the month was followed by a string of weaker labor market signals, leaving the dollar on the back foot. Third, there is a quiet villain propping up the dollar index, the Japanese yen. Renewed yen weakness is taking pressure off the greenback, which is why the dollar index has not collapsed through 99.5 entirely. In short, the Loonie is benefiting from its own strength and from a dollar that looks artificially stable because other currencies are wobbling. For anyone doing business across the Atlantic, this level matters immediately. At 1.3930, a British pound buys you roughly 1.74 Canadian dollars, which is near the best rate for holidaymakers and importers in months. If you are a Canadian exporter, though, the strong currency squeezes margins when you convert US dollar earnings back home. The FTSE and commodity-linked stocks are feeling the ripple effects too. More crucially, the CME's FX futures markets are showing traders reducing short Loonie positions, a clear signal that institutional money believes the Canadian dollar can hold these gains. Yet volumes are light, everyone is in wait-and-see mode. As Canberra's daily market report put it this morning, we are in the calm before CPI. No one wants to commit big capital when a single inflation print could shift Fed expectations by 0.5%. The U.S. Consumer Price Index released tomorrow, the 12th of August, is the only catalyst that matters right now. Markets have already priced in substantial Federal Reserve rate cuts after the recent weak jobs data, but if CPI surprises to the upside, that narrative collapses. A hot inflation number would force the Fed to stay hawkish, propelling the dollar higher and potentially pushing US dollar to Canadian dollar back toward the 1.4050 level where it was before the labor sell-off. On the other hand, a softer CPI print would confirm the Fed can cut aggressively. In that scenario, the dollar index could slice through Friday's 99.5 floor, sending the Canadian dollar toward its next major resistance at 1.3850 or even lower. The risk is asymmetric because markets are already leaning bearish on the dollar. A strong CPI would catch them off guard and trigger a sharp squeeze. Right now, the Canadian dollar's firmness looks like quiet confidence, but it is really coiled tension. A 2-month high ahead of a massive risk event is not a resting position, it is a loaded spring. If you have a large USD purchase coming up, locking in rates at these levels could prove wise. If you are trading, know that the post-CPI move is likely to be fast and violent, much sharper than the slow grind we have seen these past few days. The Bank of Canada, for its part, will be watching closely because a rapidly strengthening Loonie would help tame imported inflation, potentially giving them room to ease later. For now, keep an eye on 1.3850 as the key downside target and 1.4050 as the upside trigger. The numbers will speak, and when they do, this range will not survive.